Hi guys, welcome to a simpler approach. If you are new to the channel, please subscribe, like, comment and share. Now for the past few weeks, we've been looking at double entry. We looked at double entry for assets, liabilities and capital, and we looked at the asset of stock. In this week's lesson, we will be looking at the double entry system for expenses and revenues. Let's get started. Our objective for this lesson is to garner an understanding of the double entry system for expenses and revenues. Now, before we progress, I must tell you that the concept of double entry that you have learned thus far remains the same. Nothing is about to be changed about that. Okay? The steps, the rule, T accounts, what double entry is, all of that remains the same. All we're doing right now is to add something to the foundation that you have already garnered. Okay? Cool. Now, as usual, we usually take care of our key concepts before we go any further. Things that you need to know. All right? Now, for this section, expenses and revenues, first thing you must know. Expenses. What are expenses? Now, expenses can be described or can be explained as the monies that are spent in a business in order to generate profits. Okay, the cost of doing business. Okay, so if you're gonna operate a taxi, gas would be an expense. You have to purchase gas in order to run the vehicle, for argument's sake. Okay, revenue is the value of goods and services that are delivered, that are sold or supplied to customers. Another way of saying it, or another way of looking at it, is revenue is the reward gained as a result of doing business. Okay, so when you open a supermarket and you sell products, the reward of operating your entity is making money, getting revenue. Okay, all expenses have their own T accounts. Now remember, so far we've been opening T accounts for various things, and we have been ensuring that our T accounts are specific. It remains the same for expenses and revenues. Our T accounts must be specific. So if there are 5 expenses, 5 forms of revenue, that'll be 10 accounts. They must all have their own T accounts. Okay? The double entry rule. Now, you already know the double entry rule. Okay? What we're looking at now is the double entry rule for expenses and revenues. Now, remember I said everything else remains the same. The concept of double entry, T accounts, the steps, all that remain the same. Right now, we're looking at what is the double entry rule for expenses and revenues. Now, take a look at the diagram before you. Everything in black you already know. Assets, liability, capital. You already know all of that. Now, the items in red, we're focusing on those right now. Now, if you notice, assets and expenses, they are the same. And if you also notice, liability and revenue is also the same. Therefore, we say that the double entry rule for assets is the same double entry rule for expenses. And the double entry rule for liabilities is the same double entry rule for revenue. What do we mean? When an asset increases, we debit. When expenses increase, we also debit. Okay? When assets decrease, we credit. And when expenses decrease, we also credit. So the rule for the two is the same. Okay? Liabilities. When liabilities increase, we credit. The same applies to revenues. And when liabilities decrease, we debit. The same applies for revenues. Okay? We're going to look at two examples and wrap things up, and then we'll be out of here. Because this topic is pretty easy, you know. Yeah, so we ain't going to spend too much time on this. Alright? Alright, so first example. Paid the electricity bill by cash, $1,000. Okay? Simple, easy. Now, what are the two items affected? What did I pay for? The electricity bill. Okay? That's the first item affected. How did I pay for it? By cash. That's the second item affected. Okay? Now, the same procedure as it relates to assets, liabilities, capital. Knowing what they are, knowing how to identify them and pick them out of an equation. Mathematics is on my mind. Pick them out of a transaction. The same concept applies here. So once you know what revenues and expenses are, you will be able to pick them out. Okay? So, two items affected, electricity and cash. Cool. Determine if they increase or decrease. Now, by virtue of the fact that we paid and the electricity bill, that would mean the expense has increased. Not the electricity bill has increased. The expense has increased. Okay? Be very mindful of that. Not the electricity bill. The expense has increased. Cool. How did we pay for it? We paid for it by cash. That means that our cash is going down. Okay? Having determined that, we head to our third step where we apply the double entry rule. Now remember that the double entry rule for assets is the same rule for expenses, and the rule for liabilities is the same rule for revenues. Okay? So, our expense of electricity has increased. When expenses increase, we do what? We debit. Okay? Cash decreased as a result of paying the expense. When an asset decreases, we credit. Okay? Now, having done all this, we would go ahead now and would open our accounts and place the transaction in their respective accounts. When that is done, it will look like this. Okay? Our electricity account and our cash account. Remember that when an account is debited, it means the information is placed on the left side. When an account is credited, it means the information is placed on the right side. So in our electricity account, we have our regular information in the way it's supposed to be there. Date, details, and the amount. And the detail is the corresponding item that was affected. Okay? And the same thing applies for cash account on the credit side. Date, details, the amount, and detail being the corresponding entry. And remember, that is necessary so that the account can be easily interpreted and analyzed. Okay? And in plain Jamaican terms, it will make sense. Cool? Cool. Our second and final example. Received rent by check, $12,000. Now, I must point this out to you from the get-go. When you are dealing with revenue, it is important that you term it properly. Let me explain what I mean. This says received rent. What do you see here as the first item affected? Rent received. Now that is necessary, that is critical. Why? Because some expenses can also be revenue, and some revenue can also be expenses. What is Mr. Martin saying? Let me say it like this. It is possible for you to pay rent, and it is possible for you to receive rent. Starting to see what I'm saying now? It is possible to pay commission, and it is possible to receive commission. You catch my drift? Cool. So when you say rent, that's an expense. When you say rent received, that is revenue. So you must add received to the term so that there can be a clear distinction between the item being an expense and revenue. And that is why when it says received rent by check, we don't just say rent and leave it there. When you do that, you're referring to an expense. Okay? But in this case, we received rent. So you must say rent received. Cool. Cool. Yeah. So the other item affected, check. And you already know from the beginning, wherever you see check, we're talking about bank. Okay? So the two items affected are rent received and bank. Step number 2, determine if the item increased or decreased. The revenue of rent has increased naturally, okay, because we have collected revenue, we've collected some money. So naturally revenue is going to increase, okay, and by virtue of that fact, bank is also going to increase because the revenue was placed there. Okay, so both items have increased. Now when we apply our double entry rule, the process is basically simple because rent received is revenue which has increased, and when revenue increase, we do what? We credit. Okay, bank is an asset. When an asset increases, we do what? We debit. Okay, now when we open our T accounts to put the information in, this is what it will look like: the bank account and the rent received account. Remember, once again, when you debit an account, it means you place the information on the left side. When you credit an account, it means you put the information on the right side, using the date, details, and you use the corresponding item as the detail. All right, so March 27, in the bank account, rent received 12,000. In the rent received account, on the credit side, March 27, rent received in the bank, $12,000. Okay, you see how easy it is? It is so easy and so simple. Okay, that's the underlying concept of expenses and revenues. I hope the information is clear, simple, precise, and concise. And remember, any problems you may have, feel free to comment and we'll talk about it. Because the purpose of this is to ensure that you are understanding. Okay? And if you're not understanding, please feel free to say so in the comment section, and added information or added elaboration can be provided for you. Okay? Okie dokie? Cool. Easy peasy, lemon squeezy. If you enjoyed that video, please subscribe, like, comment, and share. And as always, if you have any queries, concerns, questions, feedback, encouragement, whatever it is that you may have on your mind, feel free to share them. Let it out in the comments section, and I will respond to you directly. That will be all for this one. So, until next time, walk good, stay safe.